dwindling. Annabelle, can you hear me?
Yes, we can hear you. Sorry, my thing
Okay.
wouldn't turn on.
I think there must be something wrong with that little speaker, but anyway, Annabelle, I sent you a message. Did you get it? That I couldn't figure out what you were talking about last week.
No, I didn't receive a message. I'm looking on my email. Let me see. No, I have no message from you.
Okay, so
I
maybe
just
look that up during class, and then we'll talk about it after class. Okay. If y'all haven't noticed, I put out a couple of videos on the rules of debits and credits, and we'll review those again here, and then proceed with some actual computational type stuff. Be sure and watch those videos. Anything I put out is, I don't want to say super important, but it might help you actually. So, and I sent out 2 yesterday, and I hope to get to another one this evening.
So I'm sure they will really help on quiz or chapter tests, right?
Oh, I don't know about that.
Oh.
Depends on how much you're grasping it. Let's see. What's wrong with my light here? There we go. Okay, hopefully y'all can see this. I don't know where my light went, but it's not there. Okay, so again, if you watched the video, this is going to be kind of a duplication. How many in here watched it? Okay, good. So it's not going to be a duplication. But as we kind of left off last Monday, our fundamental accounting equation comes totally, or is where the actual rules of debits and credits come from. This is the full-fledged formula for the fundamental accounting equation, and this is all the accounts in our system, but we will expand it in just a second to include some different accounts. These are called our permanent accounts, as we talked about last week. Permanent meaning just because the year changes or a new fiscal year begins or ends doesn't mean anything goes away. It's still there. Is that clear to everybody, hopefully?
OE?
Owner's equity.
Equity.
Yeah, owner's equity, OE. I will never spell out owner's equity because you can't read my writing anyway, so if I have to spell one more thing.
You put money in, you invest cash in the business, that means it's the amount of money the business has to keep it afloat?
Kind of. It's really more that we'll see here in what we talked about a little bit last week, in that we know typically what we own and we know what we owe. And owner's equity is what I call, what is the leftovers? If we take this equation and take what we own, subtract what we owe, that is your owner's equity. So it's not something that you can touch, see, or feel. It's not attached to one specific transaction. It is simply how much do we own in assets, less how much do we owe in liabilities, and then the leftovers, that's ours. because the accounting equation is set up in a very specific format. Assets are set equal to liabilities plus owner's equity. But this whole side of the equation is equity. So how confusing is that? But we have two people that have equity in our business, our home if it's mortgaged, our car if we have a loan on it. At all times, there's two owners, isn't there? It's us, the person that, you know, is making the payments, the person that bought the property or the office building, put some money down, but the creditors are as much an owner as you are. And so we say that the liabilities are the creditor's ownership, and the owner's equity is the owner's ownership.
Couldn't it also be like Hearst Farm Supply or John Deere, not John Deere Credit, which is their credit system, but John Deere, and the bank?
I mean, it could be a variety of different creditors.
Okay.
What I'm saying is that the creditors have ownership in our assets, and maybe not one specific one, okay? And all of this will start hopefully coming together after we get past this rule of debits and credits so that we can start working with how are we accounting for transactions in a true manual double entry bookkeeping system, because that's all we're doing in this class. Nothing we're doing has to do with QuickBooks or any kind of computerized accounting system. Everything is by hand, so to speak. So let's go back to our assets equal liabilities plus owner's equity. And we briefly talked about this last week, in that the equation, any equation has a left side and a right side, doesn't it? And that equal sign is our fundamental starting point. Everything that we own is equal to people that we owe, and then the rest of it is ours. And so we're tracking ownership of these assets, is what we're really doing, and of course tracking, of course, who we owe. And then the difference becomes ours. And so that figure is very hard to put our fingers on as far as being a physical, one-act play kind of thing. It doesn't act by itself. It's in conjunction with everything else, okay? And so as we talked about last week, we have a left and a right side to this T, bless you, this capital T, and that's just the rule of nature, isn't it? Left and right, and a T, a capital T, follows a rule of nature, left and right. But we talked about that. We call it in accounting debit and credit. That in accounting, the only thing debit and credit means is left and right, and it comes from the ancient Greek and Latin word debires and crediars. And the translation into English language is debit and credit. But they don't mean anything. They don't mean positive, negative, good, bad, up, down, deficit, surplus. They don't mean anything except left and right. And if you can get to that point about thinking it in those terms, you'll do a lot better, because they truly don't have any other meaning except their original Greek meaning, which was left and right. In case you didn't know that, that's what they mean. Okay, so that becomes then where the phrase debit and credit and why we use it in accounting is because in true manual form, every account that we're trying to keep track of, whether it be cash in the bank, furniture and fixtures, autos and trucks, accounts payable to John Deere, accounts payable to the bank, a mortgage payable to the bank, etc., will have its own account. We will never have one big account called assets. Why not? I mean, think about it. If someone were to ask you everything that you own, are you going to say, well, I own some assets? You're probably going to start listing out what you own, aren't you?
What you own and what percentage of it you own and owe credit, or owe something of that too.
Right. In other words, you know specifically what you own, right? And you know specifically who you owe, and you should. Accounting is very detailed. The better the accounting system, the more detailed it will be, because we don't have just one asset, and different assets are kept track of differently, like, you know, furniture and fixtures is gonna be completely different than cash in the bank, isn't it? If we put all of our assets into one big account and said, okay, we've got $100,000 in assets, and so you go to the bank and say, I need to make a withdrawal on my bank account in the amount of $100,000, because that's what my accountant said I had an asset. What's that bank gonna do? First thing they're gonna do is pull up your account, isn't it? And they're gonna say, well, you don't have $100,000 at this bank, because that assets can be a combination of different kinds of assets, and that's why we have to keep them separately, because we can do different things with cash as that we can do with physical furniture and fixtures. Okay? And so that's what we'll be leading to a little bit later on in the course as well. Okay, so this T becomes then our focus point. Then how are we going to determine in a manual system, because we're not going to use positive, negative, plus, minus. We don't use any of those symbols, plus or minus, even though you may have seen it introduced a little bit in chapter 2. Don't focus on those positive and negative things. Now we need to start focusing on using the phrase debit and credit, meaning left and right. And so I'm going to have separate T's for every asset that I own. I'm just doing this right now in a lump sum because I'm trying to reiterate the rules of debits and credits. But every asset will have its own T or its own page. If you can kind of think of it, this might be a piece of notebook paper. Those are the 3 little holes, you know, for your 3-ring binder. And I will have one of those pages for every asset that I own. And every page will be divided in half. It will have a left side and it's going to have a right side. And depending on what page I am on, will depend on whether I need to record the transaction or the dollar figure on the left or the right side, because whether I enter it on the left or on the right will determine if that account went up or went down. Okay? Now again, this is true manual double entry bookkeeping where we had to have a visual when it was created, and the visual was this fundamental accounting equation, the left and the right. So if I have a T account, and a T account is just nothing more than a learning tool that we use in class to manipulate accounts and to work with them. But every one of these T's has a left and right. Agreed? And it didn't change because I crossed over that equal sign. Left is left and right is right. And it doesn't matter what you're looking at, whether it be accounting or excuse me, turning right at the light versus turning left at the light. We can all associate left and right with a very fundamental rule of nature. So that did not change. What's going to change, though, is when we get to an asset page and we are in a transaction where that asset went up, we need to know which side to record that amount on, the left or the right side, because it's going to affect that account differently. So we go back to our fundamental equation up here, and in the original equation, assets fell on the left-hand side of that equal sign. Agreed? So we say that wherever an account is in the normal presentation of the fundamental equation, that is the side it will have its normal balance. So assets are said to have normal debit balances. So what do you think the normal balance for liabilities and equities are then? Liabilities to owner's equity. What would the normal balance be for those guys? Credits. Because they fall on the right of this fundamental equation up here. Left, right. So these guys have normal credit balances. It does not mean that at some point in time an account could have a credit side for an asset or have a debit balance for a liability. It just means normally, if everything, barring some strange circumstance, this is where you will find the normal balances for these kinds of accounts. So assets, wherever an account has its normal balance, that is the side that account will increase on. okay? So assets go up on the debit side, excuse me, and down on the credit side. They'll go, do just the opposite of their normal balance. So if I want that page to go up, I'm going to record those figures on the left-hand side of the page. If I want an asset to go down, I need to record that figure on the right-hand side of the page. Same thing with liabilities. Because they have a normal credit balance, they're going to increase on the right or on the credit side, and they will decrease on the debit side. And then owner's equity, their normal balance is a credit, so we will increase on the right and decrease on the left. Up with credits, down with debits. And these are rules. Rules are intended to be followed, aren't they? You break rules, then there are consequences to be paid depending on, what kind of rule you broke. You're either going to pay a fine if you ran a red light, or the consequence could be much greater than that if you ran a red light, those type of things. And in accounting, what's going to happen is it's just going to mess up everything. Your system will not be in balance. So, let's go back to this fundamental accounting equation right here. This equal sign follows all the way down our rules here. Assets equal liabilities plus owner's equity. So that means that ultimately, this is true. Debits equal credits. So double entry accounting basically says if you go into your system and you enter a debit to one account, what do you think you're going to have to do in conjunction with that same transaction?
Enter a credit.
Enter a credit. So for every one transaction, there's at least 2 accounts that are affected, minimum of 2. One account is going to be debited and one account is going to be credited. You'll have to make that determination which accounts are affected. And we'll talk through a little bit of that in just a second. We'll actually apply this to a problem.
Can I try to see if I put this in more of a plain layman's term?
Okay?
Okay, so you're gonna have to make that big payment at the end of the year on that piece of equipment. Well, that money's going to come from somewhere called an account.
Cash.
So but you have to make this payment at the end of the year to a certain entity, so it has the same amount as go over here. That's basically what we're saying.
Cash has been affected in that transaction?
It's very simple, but.
Yeah, cash has been affected in that transaction,
Yes.
and a debt has been affected, a liability.
But money didn't come out of thin air, it had to come from somewhere.
Yeah, but that's not the problem with that one transaction. You've got to look at one transaction, one debit and credit. And the reason why you've got debits and credits in balances at the end of the year is because you've been entering into them all year long. Does that make sense? In other words, your cash didn't appear in your bank account overnight. You've been depositing all year, you've probably been withdrawing all year, and so you're keeping track of that all year long.
Or you've been withdrawing all year until harvest, and then finally you have cotton sales.
Yeah, I mean, it's still every transaction on its own, okay? That's the number one thing. Don't try to see this great big picture, because this great big picture came from a whole bunch of little bitty transactions.
See, I'm a big picture guy.
Well, accounting is very detail oriented, so. You've got to shift your mindset. Okay, so now let's, one last thing. If an owner were to only deal and exchange assets for liabilities, or liabilities for assets, or to put money in, like you talked a second ago, adding cash because you're starting the business, that's really not going to get the business anywhere, is it? I mean, you've got to start doing what to make this business flourish?
Spend money.
Before that. I mean, you may have to spend some money first, but what is going to ultimately make any business grow?
Investment.
You have to do work.
What?
You have to do work.
Yeah, you gotta start performing, if you're a service-oriented business, you gotta start performing services, don't you? That's just the way the world works. No work, no pay, no business growth. And of course, again, in this class, we'll be concentrating on a service-oriented type business versus a company that is making their money from investments or various and sundry other things, selling product. We're focusing on John or Jane is, I like the cab scenario because everybody can kind of visually see what's going on, or in your mind imagine what's going on. So we've got John and Jane that have a cab company. We'll just stick with Jane for right now. We're going to be politically correct. Jane's got the cab company, and Jane needs to go out and start driving that cab to make money, doesn't she? Just going to the bank and borrowing money is not going to help Jane, because eventually the bank is going to want to be paid back. Yeah, plus interest. So this is the fundamental equation that, I mean, think about it. If Jane goes out and drives her vehicle all week long and makes $500, who does the $500 belong to?
Not just Jane.
Well, let's put it very simply, just that one transaction. She makes $500 in fares. Who does the $500 belong to?
Just Jane.
Just Jane. Exactly. That's Jane's money. So we could say that her cash went up $500 and she didn't borrow it. She went out and drove her cab all week long. The money is hers. Agreed? So there's a very fundamental presentation of a transaction with two entries. We recorded the fact that her cash or an asset went up, and her equity went up because she didn't borrow it. Now she may take the money tomorrow and pay off an existing debt, but that has nothing to do with that one transaction of Jane driving her cab. Okay? So, what is the problem though if I do this all year long with one little equation, and every time, well, let's say that at the end of the week she also needed to go and put some gas back in the cab. So let's say that she filled up and it cost her $40. Did her assets just go down? Yeah, her cash just went down. Did she use it to pay off some pre-existing loan? Did I say that Jane went and paid $40 on a credit card? Nope, didn't say that. I said she went to the pump and gave the pump person or whoever it was, the cashier, $40 cash.
Oh, so this next line has Jane, so this next line had Jane do what with $40?
She's buying some fuel,
Oh.
okay? So her cash went down $40.
Mm-hmm.
She did not pay off an existing debt with that $40. So whose money did she use to buy the fuel?
Hers.
Hers.
Money.
Yep. So her equity just went down $40, and I'm using that plus sign just because. So now Jane's total assets are $460. She still doesn't owe any money, and her equity is $460 if I were to, add these columns. So again, that's the double entry, and that's the rule of for every one transaction, two accounts are affected, so that at all times our equation stays in balance. So I just want you to think for a second, if you were a small business and someone told you, well, you can keep books this way by just creating this one little equation and you'll be fine. Can you imagine after you've made, say, 120 deposits during the year, and you've written 300 checks during the year, and they were all for various and sundry different transactions, what would this equation look like by the end of the year? A mess. I mean, we may have it nice and neat on an Excel spreadsheet, and this column equals this one plus this one, but what is the information inside of it that I need to get? Why do I need the specific details of how did I get down to the end of the year with $1,500 in assets, $200 in liabilities and $1,300 in
So
equity,
you know where your money's went,
right? I wanna know where my money went.
and I know we can't,
You wanna know the end result rather than just a vague summarization of the entire.
Yeah, I wanna know, did I make money? How much did I bring in revenues? How much should I take out for expenses? And not only do I wanna know that for my own benefit, but who else wants to know?
my lender.
Your lender? What?
And the IRS, can you write it off?
The IRS wants you to report specifically how many dollars you brought in because you earned them, and how many dollars you spent in legitimate business expenses, so that you can pay tax then on the net, the difference between what you earned minus what you spent to earn it. So there's all kinds of reasons why this does not work in keeping everything in an equation. And again, we'll get further along as we go. But the point here is that both of these transactions, Jane earning $500 in fares and Jane spending $40 in fuel, were both taxable events. One was an increase in revenues that will, of course, eventually increase her tax liability, and the fuel was a reduction in that taxability. But looking at this, you wouldn't know that, would you?
No, and you wouldn't know she'd be able to take that $40 off as a law, depreciation, I mean, as an business expense,
Why not?
because it's not labeled.
Right, but neither is the $500. So, we have to have something that's more efficient, in other words. And so the fundamental accounting equation, when it was developed, we didn't worry about whoever developed it, many years ago, was not worried about, number one, profitability. They just worried about going to an open market and keeping track of what was theirs in the market, and then maybe possibly what they traded it for. And this equation worked very well. But now we live in a society that does want to know, was Jane or John profitable by the end of the year, and how much tax do I need to pay on that profitability? So I've got to separate some things. So if you agree that this revenue and this expense right here belong to Jane, because that's why we put it in that owner's equity account, then you'll understand what I'm fixing to say, and that is that revenues, expenses, and any owner withdrawals that Jane or John make in their business are also equity accounts, okay? So these are our permanent accounts in our system that we just talked about a second ago. They don't go away, but we talked about last week, we only pay income tax one time on revenues that we earn or wages that we earn, but we can only deduct expenses one time. So somehow we've got to separate those transactions that are revenues and expenses happening in owner's equity into accounts that we can account for them on an annual basis and then dump them. If we're done, we're going to start a new year. So we created, or whoever created this, created some temporary owner's equity accounts. And it's important to keep that in mind because the rules of debits and credits feed off of the fact that these are temporary owner's equity accounts, not temporary assets. There's no such thing as a temporary asset or a temporary liability. Okay? Now that's not to say some assets will go away or liabilities will go away, but that's because we either pay off the debt or because we get rid of the asset, not because they just have an accounting thing that we have to take care of at the end of the year. So to this equation, we can add revenues, subtract expenses, and subtract withdrawals, because that's what these three accounts do. They increase owner's equity or they decrease owner's equity, because they are owner's equity. That's just a really super important point that you either eventually grasp or you've already got it. This is one of chapter 3 especially is a super important chapter that you probably need to read 2 or 3 times to kind of get what's going on. That's just the bottom line. And again, for some of you, this is never going to become crystal clear. You're just going to be able to do enough to get through. And like I said, that's okay. It's just There's something about the brain, and I can't get inside of your brain and make some, changes so that you can get this, if you're following me. Just like we talked about, I absolutely detested economics, and no one was gonna be able to get inside my brain and make me be able to figure it out, because it didn't make sense to me. It wasn't real, so to speak. This, to me, is very real, very black and white, because you're dealing, eventually, with paper. And if you have a set of rules, it's just like kind of putting together, if you've ever played with Legos or have kids that have Legos or whatever, and you buy those kits and it's supposed to, turn into this big elaborate spaceship or a boat or something, what do? If you want it to look exactly like the picture,
Follow the directions.
you follow the instructions, don't you? And you go step 1, step 2, step 3, and it leads you through exactly what to do. And if you skip some of those steps, what's gonna happen?
You're gonna have a bad time.
Yeah, you are not gonna have a fun day, are you? You're gonna be starting all over again, aren't you? And so that's the thing with these rules. It may not feel like, and if you've ever done anything with the Legos and stuff, sometimes it just doesn't. I remember doing it with my son. It shouldn't. Well, that's not right. That couldn't be right. They left out something. You're trying to make sense of it. But if you follow the rules every single time, you're going to get a lot closer to the right thing than if you try to make something out of it that's not there. So I will.
You said something that really good. You do not understand, you do not like the economics. I like it.
Well, good luck in accounting.
So, yeah, I might.
That's all I'm going to say. Okay, so we've already established that these are our three main, those are our three accounts of the fundamental accounting equation, keeping in mind that owner's equity encompasses everything, doesn't it? It's really 4 accounts in one. It's owner's equity, revenues, expenses, and withdrawals. All of those are owner's equity accounts, okay? And we've established the rules for these 3 accounts. Assets go up on the debit side, they go down on the credit side, liabilities, and owner's equity just the opposite. They go up on the credit side and down on the debit side. Because assets have normal debit balances, liabilities have normal credit balances, as does the owner's equity. And all because why?
Because the liabilities and owner's equity are on the right side and assets are on the left.
Right. All because of that. No other reason. That whoever established and created this system of accounting, that's what they were basing their system on. And believe it or not, all computerized accounting systems in the world, I don't care if it's from the very simplest computerized accounting system to the most elaborate that you could find in the world, all of them are based upon debits and credits, meaning left and right, and establishing what accounts are assets, liabilities, and equities, and how we treat them. Every single one in the world. I'm not sure that we have any other, there are, I'm sure, but in my mind, in the world of business, there's not anything that we do in business that can be tracked back to BC times that we still have in place. But that's how old this is. So that means it's 3,000 or 4,000 years old, at least. Okay? So just to keep that in mind, they had no tools available to them except I guess they used rocks and something. I don't know enough about ancient anything to know what they used, but this is what they were doing, making their markings. It was a debit and a credit and a left and right. Okay? So now I'm going to add, though, my 3 temporary owner's equity accounts: revenues, expenses, and withdrawals. And just, again, to redefine them, revenues are accounts that we keep track of those elements of earning a living, whether it be Jane driving her taxi, or John mowing lawns, or Fred over here washing cars, all of these are considered revenues. If money comes into the business because they were earned, we call them a revenue. But they're still the owners. Any monies that are spent in order to earn that revenue, a direct business expense, are called expenses. And they're gonna be deductible on a tax return or on a profit and loss statement. They're gonna show that I may have earned $10,000, but it cost me, $4,000 just to get to that point, buying fuel and insurance and, et cetera, et cetera. Withdrawals, on the other hand, are separately kept dollar figures that the owner withdraws for their personal use to pay utilities, rent, groceries, things at home that they needed some money for it, but it was not a business expense. And most owners want to keep track of that separately in a withdrawal account versus taking it directly from owner's equity, because they want to, at any point in time during the year, they want to be able to pull up that withdrawal account and see, in 2021, how much have I withdrawn from the business? Okay? Because if I've withdrawn $20,000, but my revenues are showing I've only earned $10,000 this year, I might want to rethink this withdrawal thing. Okay? So that's why we have three different categories here for three different times that the owner affects their own equity. They either earn more equity, they spend it on expenses to create revenues, or they withdraw it for personal use, and that has to come out of their equity.
Or for business expense, when you're making your new budget, well, how are you gonna do that? Cause there's so many unknowns.
But
So
we're
you
only,
have to go by what you did the previous year plus add.
well, we're not looking at anything budgeting wise, we're just talking about these are actual transactions that we're recording and keeping track of. Budgeting is a whole different ball of wax, so to speak. Because budgeting is a future event. We're talking about real-time events that are happening day to day that we're recording. Accountants are very much recording past history.
I
so to
was
speak.
just saying such the importance to have everything labeled correctly and in the right spot so that you can see what your future.
Mm-hmm. Yes, that's a good point.
Assets are basically, say you got a huge pile of treasure. Liabilities are, you could kind of say that liabilities are pieces of treasure you give to someone, and owner's equity is the treasure you have left.
Right. Or maybe you had to borrow a bunch of money to go find the treasure.
You had to borrow a boat,
Yeah.
had to hire people to help you.
Yeah. So those are the liabilities that you might have to use some of that treasure to pay some of those liabilities off, and then the remainder will be yours. So, okay. So, these are T accounts. Do they have a left and a right?
Yep.
You bet. But we call it
Debits and credits.
debit and credit. And it didn't change as I quickly labeled my accounts across the page here.
Liabilities are basically, there's something put on your tab, you better pay it.
Yes. That's right. It's something that we owe.
Right.
Okay, so let's, I'm gonna give you the rules, but I want you to think about why I'm giving them the rules I'm giving these three accounts. Owner's equity. We know that these guys are 100% temporary owner's equity accounts. So they have to follow the rules of owner's equity. Would you agree to that? So revenues do what to equity? Every time Jane goes out and earns more fares driving her cab, what is she doing to her equity ultimately down the road?
Increasing the credit.
Increasing. She's increasing her equity, and we know that equity goes up on the credit side. So revenues, we say, are a mirror image of equity in that they have a normal credit balance. We'll record them, or they will go up on that credit side, on that page. And if we happen to refund a customer something along that line, we would reduce that revenue on the debit side. Okay, now without looking at your owner's equity account, well, I guess kind of look at it. What do you think expenses and withdrawal, well, I mean, what do we know expenses and withdrawals do to Jane's equity? If she has to go buy more fuel, she has to go buy some insurance.
They decrease her equity.
That's right. Every time she has to go buy fuel or insurance, her equity is reducing itself. What makes equity go down? What, a debit or a credit?
A debit.
A debit. That's what the rule says. So we say that these guys have normal debit balances. Every time she pays for an expense or takes money out personally, that is reducing equity. Therefore, we say they are increased on the debit side, expenses and withdrawals, and then they would do the opposite on the credit side. In this class, you'll never be crediting an expense account. You'll never be crediting a withdrawal account. So I'm just telling you that that's what would happen in that event. Maybe she got a refund of utilities, then her utilities would go down on the credit side. So there are your rules, and again, these are rules that are not intended to be broken, and if you do, you're probably going to get the problem wrong. That's just, you know, it's like you run that red light and you get caught. There's consequences, right?
So, let's see, we labeled these temporary OE accounts, these three above, the three two accounts above, we labeled them
Those are permanent accounts.
permanent.
Yeah. But they're not all owner's equity accounts, they're just all permanent. Permanent assets, permanent liabilities, and then the one permanent owner's equity account. But owner's equity really has four accounts: the permanent, the revenues, expenses, and withdrawals. And then at the end of the year, if we've accumulated dollars in the revenues, expenses, and the withdrawals account, because they're temporary, what will end up happening in chapter 4, I believe it is, you're going to see that these accounts end up being dumped. We're going to move the balances from these accounts into owner's equity so that next year we'll start and they'll have zeros in them again. So it's kind of the way the definition of temporary works is that they have dollars inside of them from January 1 to December 31, and then they go away. And you say, well, that's the whole year.
Taking the treasurer analogy in account, no pun intended. Well, revenues are basically like something else is added to your share of treasure, or?
No, a revenue is something that you have earned.
Oh,
So maybe you went on another treasure hunt
right.
and you found more treasure, then you earned an additional revenue, so to speak.
Right.
Okay.
Either way, you're working to get money.
Right. Whatever it is that you do for a living, that's a revenue to you. Whether it be driving the cab, mowing lawns, doing tax returns, teaching a class, you know, whatever it is that you do to earn monies that eventually become yours, that is a revenue. And expenses are how we get there. And like in my business, outside of South Plains College, I really hardly have any expenses now. That almost everything I do, well, everything I do is done with accounting and tax software. So I have about 3 major expenses during the year. And then I really don't even spend money during the year. I have my software, which is a huge chunk, of course, lots of copy paper, and lots of ink. And besides that, really maybe some fuel now and then to go and meet with a client or something. There's just not a lot of it. My particular business is very low in on the expense side as far as the number of transactions. It's costly, the software that I use, but I only do it once a year. Whereas some businesses, like the taxi cab driver, what's going on every single week that Jane's got to do?
Constant gas and then constant upkeep of the vehicle.
Yep. Every week, if she's having a successful business, she's going to be putting more fuel on that vehicle or adding some maintenance to that vehicle. And then once or twice a year, she may have to change tires or do something major. Yeah, insurance, that type of thing. Okay, so every business is different. But the point is, these are your rules of debits and credits. Sleep on them, paste them to your computer, whatever you have to do. They're rules for a reason, and if you violate the rules, you're gonna get the problems wrong. So now let's look at a couple of problems. Probably most of you do not have a physical book, is my guess. Y'all do things completely differently than my brain works. My kids never have paper, ever, on anything. I'm like, can you give me that receipt for so-and-so? I really need it so I can do so-and-so. Mom, I don't have a receipt. It's on my phone. I'm like, well, I can't access your phone. So, y'all are just completely different than the way I think. So, I've got a physical book in my hand. I know, does anybody have a book? Oh, see, good. We got one here that thinks just like me. So, I'm going to show you, though, we're going to go over a couple of things, just to kind of reiterate what we're doing. Let's see if I can find one that I haven't marked on. There's one. If you have a book with you and you want to follow me, I'm looking on exercise 3-2B, and it's probably got assigned in your homework. Remembering that you can go back to your homework at any point in time and redo it. And try for that 100, or do it again just for reviewing. Yes, whatever that word is.
These are the things in the chapter, if we go out and read, and then down below, usually I think it's blue.
Yeah, these are exercises that are at the end of your chapter.
Oh.
And in your, of course, in Cengage, what's happening is it's your homework assignment. When you click on that homework assignment, they're pulling them from your assignments at the back of the chapter, at the end of the chapter.
Oh, so, okay.
Okay? So I'm going to do one here that I want to write out on paper before we start one that I'll put back up here. But there's an expression called footing and balancing an account. And this is exercise 1B, in case you run across it in your homework. And they gave you an account with this name at the top. So what kind of an account is this? Accounts payable.
Account you owe money to.
Exactly. It's a liability, isn't it? Okay? That doesn't really matter when I'm trying to get the balance on this account. What I'm going to be looking at in a second, though, is once I get this balance, is this normal or not for this particular account? So in this particular problem, they put $300 and $250 on the debit side, and you see $450, $350, and $150 on the credit side. So in accounting, we use an expression that you may have never heard before. It's called foot and balance. What does foot mean to you? And I don't mean your physical foot.
Your base.
Kinda. Where are your feet in relationship? If you're standing up, where are your feet? The bottom. So we're going to go to the bottom of the account, add the columns, and determine what my balance is. That's what we mean by foot. So I'm going to draw a line here at the end of these transactions, and I'm going to add my debit side. I've got $550 in debit. Would you agree with that? And then I've got $450, $350, and $150 on the credit side. So what is that? $950? Y'all correct me if I'm wrong. I do not do math well, believe it or not. Why do you think that is? I've been doing accounting for probably longer than some of you have been alive, but.
Because you don't keep track of a negative or a positive.
Accounting isn't math, it's accounting.
Yeah, I've got a 10 key sitting on my desk that does all that for me. All I do is put in the numbers. So I don't even think about what I'm doing anymore, but I'm just adding and subtracting. So if you got a simple calculator, you're good. So if you get used to using those things, what can you not do? Like I used to be able to rattle off phone numbers of all my clients, of, you know, anybody that I grew up with, you know, et cetera, but what has the phone done to all of our brains? Turned them into mush.
I still remember friends from high school or whatever now.
All I can remember is my old home phone number, but that's about it, and my dorm room number. So I don't know why, but. Anyway, the more you get acclimated to machines to do things for you, the less you think. But accounting, you have to think, because there's no machines out there that are gonna do it for you, even if you're using QuickBooks. And we'll talk about that later.
Really?
So I've got accounts payable up here at the top, I've got 550 on the debit side and 950 on the credit side. These came from transactions, you know, from prior time, from now, we're just isolating this one account. So, what is my balance on this account? What do you think?
Negative
400,
400?
not
No.
negative.
Why,
Just
why did you put a
400.
negative in front of it?
Oh, I guess I had my mind backwards.
No, it's not backwards, I mean, that is probably a lot of you thought that.
It's a mathematical way you go from left to right in
Right.
regular math.
You went from left to right, and all of a sudden you got this negative 400. But we're not doing that in here, we're saying that the credits were larger than the debits, agreed?
Mhm.
And now this is carrying a credit balance, because it's larger than the debit balance of $400. That is balancing and footing an account. This account now has been footed, meaning I've added the debit column and the credit column, and I've balanced it by finding out which side was larger, and recording the balance on the larger side. And then, of course, this little squiggly line indicated to me that I was balancing this account. That's an old accounting thing too. I literally still have my squiggly rulers. I don't know if you can still buy them or not, but, one side was a straight edge.
So to put something into like, to put a stamp on the side of the account.
Kind of, saying, I've done some work on this account and here's my balance. And that's what this double line underneath it, that's kind of your stamp right there. I've done it. So is this normal for accounts payable to have a credit balance? Yes. The liabilities have normal credit balances. So this is telling me that I owe someone $400. Okay?
This means you spent more than you earned.
Not necessarily, it just means that at some point in time, I borrowed, some money, I paid some money back, but I still owe somebody $400. Okay? So, and it really is that simple. Would you call this an algebra problem? I wouldn't. I mean, I remember algebra. No.
No.
It's not trigonometry, it's not calculus. What is it? Addition and subtraction. And keeping two sides separate from each other. Okay? Now I'm gonna pull back up the book and let's look at exercise 2B, in case you have your book with you or you're on the computer. And we're just gonna kind of talk through some debit and credit analysis, that you're getting down what's happening and what we're trying to accomplish. It says it wants you to complete the following statements with either a debit or credit. And this is all about the rules of debits and credits. So, you know, you have your rules in front of you, see if you can answer them. The asset account, prepaid insurance, anything prepaid is an asset, would you agree with that? Prepaid rent gives you the right to live there, prepaid insurance gives you the right to drive around town. All of these provide future benefit. So the account, the asset account, and they told you what kind of an account it is. Prepaid insurance increases with a what? Debit. Because it is the key word, asset. And we have a rule that tells me assets go up on the debit side. So again, if you're a rule follower, perfect for this class. The second one, the owner's drawing account or withdrawals, there's a couple different words for
With
this,
credit.
is increased with a, look at your rules, don't try to guess it. What'd you say?
Debit.
Debit. Because why?
The rules say so.
Because my rule says withdrawals has a debit and a credit side, but its normal balance is a debit, therefore it goes up on the debit side. This is where people will get in trouble because they want to try to make sense of, or make something out of debit and credit that's not there. the other side, over here. The asset account, accounts receivable, and they've already told you this is an asset, and accounts receivable means that someone, you know, owes me money to be received, so it is an asset. All assets, regardless of what kind it is, are decreased with credit. Why? Because my rule said so. Normal balance is a debit. If I want it to go down, I use a credit. That's why I say you have to sleep on these rules, you have to have them in front of you, whatever it takes for you to understand that there's no guessing here. It's literally looking at your rule. So if I have a liability account called accounts payable or all liabilities decrease with, look at your sheet. What? Accounts payable or a liability account decreases on the debit side. Doesn't feel like it though, does it? And we'll talk about something else again in just a second, that why you're feeling the way you feel. What about the owner's capital account? And in this book, if you've read the chapter, you know that owner's equity and owner's capital are synonymous. They're the same thing. I use owner's equity. Owner's equity is increased with, what does the rule say? Credits.
Owner's capital is synonymous with owner's equity.
Yes, same account. Okay, now they're telling you that we're gonna look at a revenue account called professional fees. Any revenue account is increased with credit. That's what the rule says. Increased with credit. Everybody getting the drift that this is not a guessing game, this is a rule game. Okay, now we've got an expense account called repair expense. Expenses are increased with debit, because that's what the rule says. Okay? No thinking about, oh, I don't know, that doesn't feel right. Well, it doesn't matter what you feel. Sorry, but. Okay, the asset account cash. Any asset account is decreased with a credit. Very good. Because that's what the rule
Basically,
says.
say, we're gonna need a little bit of your treasure to pay us some of my family rent, so can I give you some of your treasure, please?
That's right. Credit your cash. Credit your treasure. Okay, the asset account, delivery equipment, another asset account, is decreased with what? All assets go down on the credit side. And you've probably got several of these in your homework just like this, or very similar. So if you got them wrong the first time, go back and do them again. Hundreds will guarantee you that you're gonna get through this class, and you can do them as many times as you want. Okay.
And where will I find this record?
It's probably in your homework assignments.
In the homework, okay, 'cause I've already
If you've already done your homework, you've probably already done them and didn't realize it.
didn't realize it,
Mhm.
okay.
Because they're probably presented it a little bit differently, and you,
It's where you could go through, have LO through 1 through 6, and you can do it over and over and over, improve your score, and
Until the deadline.
yeah, I think the homework is opened, till the deadline, and then it will start taking, points off, I think.
Start
So-
taking points off every time you do it past the deadline?
Not, it's kind of complicated the way that works on the homework. I'll have to ask that question, but,
That's why I prefer to just look at my homework and see how everything adds up rather than do. Because, well, if I was able to do it after the deadline, just as a practice thing, then I'd do it, but since I can't do it after the deadline, I'm left with just looking
Yeah.
at it.
well, think about it this way, that your deadline, it's probably coinciding with, the quiz and eventually the exam is not a different deadline. I'll have to ask that question if they can help the homework be, I don't think it gets penalized anyway. And if it does, all you gotta do is email me and let me know. I redid my homework and now it's taken off some points. But I think the computer, I think it knows that you've already completed it once. So, okay. Now I'm going to, look at 3B right quick. And we're gonna put this in some actual T accounts. And so this is probably one of your homework assignments, like I said. And it's giving you 3 transactions for Robert Alvarez, who began a business, and he was running Roberto's Fix-It Shop. And he's done nothing prior to today in his shop. He's just now opening it, okay? So let's kind of get on the page here that Roberto is going to have several different or new T's that he's going to be dealing with. And so I'm just going to create some T's here on this page and show you how entries are made into these T's, based upon the transactions they tell us. I'm not going to put the name up here on the T's yet until I know what accounts are being affected with every transaction that Robert has got going on here. Okay? So the first one says that he invested cash in his business of $6,000. So can anyone identify to me what 2 accounts were affected when Roberto made a deposit into an account to open up his business? What 2 accounts were affected? Assets and owner's equity. What asset?
Cash.
Cash. So I need to start keeping track of some cash, don't I? And when I use the term cash on a T in this class, it's talking about cash in a bank account, a checking account. It's just easier to write cash. And we just said his owner's equity, so we could say Roberto owner's equity, and we know that that got affected. We just have already determined that, because for every one transaction, at least how many accounts are affected? 2, always. So cash just did what? When he put $6,000 in the bank, his cash account now should reflect $6,000 in the bank, agreed? In other words, he's got more cash in Roberto's Fix-It Shop bank account today than he did yesterday. So cash went up or down?
Up.
Up. What does your rule say regarding assets? How do they go up?
It increases on the debit side.
They go on the debit side. So I need to record $6,000 on the debit side of cash. Okay? And we just said that his equity was affected. How was his equity affected? Did it go up or did it go down?
It increased.
It went up.
It also went up. And equity, the rule says equity goes up on the
Credit side.
credit side. So I'm gonna record $6,000 on the credit side. Do my debits equal my credits?
Yep.
Yep. I've got a $6,000 debit and I've got a $6,000 credit. My balance, my equation is in balance, so to speak. My debits equal my credits. So for every time you have a transaction, this is the thought process you have to go to. What 2 accounts are affected, and did those accounts go up or down, and follow the rules for that account. Okay, I'm gonna keep moving because we're gonna run out of time. And Annabelle, if we run out of time before, and don't have time to talk about your homework, be sure and check your messages and email me or message me back.
And I'd love to talk about the trial.
The trial balance?
Trial balance.
Okay, we'll do that, and if I can, I'm gonna just kind of breeze through this real quick, and I'm gonna show you a trial balance, okay? So, transaction B for Roberto's shop was he purchased supplies for cash of $1,200.
Cash.
So what 2 accounts were affected?
Cash.
Cash.
And OE.
No,
Oh, my
cash and,
It's an expense.
well, in this class, I can see where you'd call it supply expense, but in this class, anytime we buy supplies, supplies are considered an asset. Because they're considered to be something that we can touch, see, and feel for a while. Okay? So cash was affected, and now a new account, supplies, was affected. So supplies went up, didn't they?
Mhm.
by $1,200. Supplies as an asset goes up on the debit side. He used cash to buy them, so what happened to his cash? It went
Down,
down.
But this
And
is
cash
by credit.
decreases
the credit side.
credits, but that's because it's causing a decrease, isn't it?
Yeah.
So I will credit cash for $1,200. So now I have a debit and a credit for that one transaction, and my debits and credits still equal. And we'll prove that in the trial balance in just a second. I'm just kinda watching the clock, so I don't wanna lose Annabelle here. Okay, and then the last one said that Roberto paid a utility bill. Well, what would you call that?
Utilities expense.
Business.
Utility expense. It is a business expense, but we do want to name our business expenses pretty, what do you say, what's that word? Detailed,
Categorized.
so that we know where we're spending our money. Thank you for that phrase. So we're gonna call this one utilities expense. How do you pay for the utilities? Pay the utility bill. Did I send the utility bill the utility company, did I send them cheese and eggs to pay my utilities? No, I sent them cash. So my cash went down, agreed, by $900. They must live in Lubbock, LP&L, be the only one charging $900, right? So cash went down $900. Cash goes down on the credit side, so I'm gonna record a credit of $900 to cash, and my expenses
Go up
basically
on
went up, and expenses go up on the
debit.
debit side. Okay? So those are three very simple transactions that every business will encounter at some point in time. Now let's foot and balance them and do a trial balance. A trial balance is a very simple little form that basically proves to us that debits still equal credits after a round of transactions, okay? So my cash, I had a $6,000 debit, and I've got two credits that total, what, $2,100? So my balance of cash right now is how much? $3,900? Thank you. On the debit side, because why?
Debit and credit, or
Because the debits were 6, the credits were 2,100.
you
My
have
debit-
more cash than credit.
Right. My debits in cash are larger than my credits in cash, so it carries a debit balance. And then all these other guys only had one transaction, so that is their balance. Everybody agree with that? Okay, now let's do a simple little trial balance. A trial balance is usually done on a piece of paper with two columns on it. A debit column and a credit column. Kind of visualize in your head that I'm working on an Excel spreadsheet or something. And I just created two columns for myself. It's a trial, meaning I'm just kind of testing my accounts to see, how do I look here? And I've got 4 accounts. I've got cash, owner's equity, supplies, and utilities expense. So